Welcome back. We are just going to look at the Jayaprakash story and get Ashmit to talk to us about what this really means, both from, of course, a home buyer perspective. There's been a fair bit of interest there, and of course from a stock perspective as well. But while we do that, let's also bring in Girish Pai, Head of Research at Nirmal Institutional Equities, who's with us here in our studios to discuss what he makes of things. Girish, good morning. Great to have you with us here. Thanks very much. So one can keep complaining about valuations, but market keeps moving on. So how do you square this?
See, it's all dependent on flows. I mean, especially domestic flows. And I think as long as we have fairly decent flows coming through, we can keep talking about earnings growth not coming through. Even this year, when the year started, I think consensus earnings expectation on index was somewhere close to late teens. So we're down to like mid-teens or early teens, so to speak. We'll probably go down to like high single digit. But market will keep moving up, even if we see FI outflows, as long as the domestic flows are fairly strong. I think the speed breaker could be supply, whether it's going to come through the primary market or QIP issuance and stuff like that. If that is going to be sufficiently large, which is going to absorb this domestic supply, I would probably think that the movement forward could be a little slow. It may not be really fast. But I think the movement does look positive from here on. May not be, may not be very great. But that is entirely dependent on flows. Earnings still looks fairly patchy to me. I mean, there are pockets which seem to be growing reasonably well, but there are lots of other patches which are not doing as well. So that's how it is.
You know, on earnings, Macquarie put out a note this morning, and they are essentially saying that financial year 19 earnings growth will be 15% and not 21%.
Right.
As everyone is expecting. Where were you at in terms of 19?
We don't cover quite a few of these sectors. So I would think that, see, that's been the story for many years now. Yes. We start off with a fairly high number. But isn't 19 supposed to be that year when we finally break the jinx? I think we can. I mean, so we've had, ever since FY 08, we've grown index earnings at somewhere close to mid-single digit. So we've reached a stage where I think we should see some kind of explosive earnings growth come through. The question is, which year are we going to see that? And maybe FY 19 could be the year. We thought FY 18 would be that year but we had GST come in, we had effects of lingering effects of demonetization kind of play out. So, and obviously the NPA issues is playing on the earnings of PSU banks and stuff like that. So going into FY 19, maybe we've kind of covered some of that. We would probably get over some of the ill effects of demonetization and GST, and maybe we would have solved some of the NPA-related issues. So I think going into FY 19 and 20, I'm slightly more positive on earnings growth. I think things could look a little better than what the single-digit kind of number we've kind of been able to deliver.
Okay. Girish, there have been a set of stocks which have been underperformers, the IT space as well as pharmaceuticals. If you had to take a bet at these levels, between the two sectors, which one would it be, time frame, and why?
So between the two, we as a house, we like pharma. IT, our call is that structurally, at least in the next 3 to 4 years, the kind of earnings growth we're going to see there are going to be optimistically, for the larger companies, that is tier 1 companies, would be high single digit in INR terms, optimistically. So that's a sector we think is more of a trading sector. Pharma has seen a fairly large cut in earnings because of issues connected with compliance, pricing pressure in the US and stuff like that. But looking beyond, say, 24 months or thereabouts, we think that pharma is a sector to be in, the underperforming sector to be in, so to speak, because there are a lot of positives here. I think one of the things that people don't appreciate, at least that's what our analyst says, is that out of something like 2,200 drugs, generic drugs in the US, 52% of them have very limited competition as things stand right now, just about 3 players. The drugs that Indian companies are present in have a median competition of between 6 to 11 players. Then there are a whole lot of other things on the horizon, in the sense that the patent expiry opportunity of about somewhere close to 200 billion playing out. The price competition has been more in oral solids right now. There are other dosage forms where the price competition is not that high, and we're not present as much there. There is this whole injectable space where we can make a mark on. There is a complex generic space where we can do very well. So I think the drug pipeline is fairly good across a lot of companies. So we're fairly comfortable with pharma. There's been both earnings cut as well as PE multiple compression that's happened in the sector. We think that maybe FY18 and maybe FY19 could be the bottom part of the earnings cycle, so to speak, for the sector, and things should recover from there. So basically, it's a 2 to 3 year call on the sector. We think that a lot of the bad news is in the price right now, and of course there could be bad news coming through on FDA front, and some of those things are definitely going to play out in the next few months and quarters. But if one has a stomach, I would think that that's a sector to kind of take a big bet on right now.
Okay. Stocks such as Larsen and Toubro also have performed fairly well. 37% returns year to date, 9% this month itself. What is the story with L&T? Are you liking it? How would you approach it?
See, we don't cover Larsen specifically, but within the infrastructure / capital goods broad area to look at, we are selectively positive on cement. We think that cement demand growth will be probably about 4-5% this year in FY18. But within that, we like certain stocks. Say Dalmia Bharat, for instance, is a stock that we kind of like very much, because we think that that particular company can deliver low teens kind of demand growth for the next couple of years because of the presence in certain parts of the country. So it's present in the south. It's present in the eastern part of the country, which gives you very good realizations per ton. So this is a company which is delivering an EBITDA per ton of almost like 1,400 rupees, whereas it's running at a capacity utilization of about 55-60%. So there's a fairly strong possibility of this delivering a good growth. The valuations are not as expensive as Ultratech is currently trading at. Ultratech is going at somewhere close to 18-19 times EV/EBITDA on FY19. This is coming at 10-11 times EV/EBITDA multiple. So that's a stock that we kind of like. So select stocks within the cement space is what we like. L&T, I'm not able to really give a view on that because we don't cover that stock.
Girish, it's a pleasure. Thank you very much for coming in, and good chatting with you as always. Girish Pai there with his perspective on markets, earnings and sectors. We'll take a very quick break here. We'll come back in 2 minutes and we'll speak with the management of Navneet Education. I mean, over the weekend, you must have read in newspapers that NCERT is essentially set to revise its entire syllabus. Does this mean more business for a company like Navneet? We speak to them in just 2 minutes. Back in 2.
18 साल दिए हैं इंडस्ट्री